Dan Coatsworth. Welcome to the Age of Bell Money and Markets podcast. Joining me on the show this week is Tom Sieber. Hi there, Tom.
Hi, Dan, and hi to everyone watching or listening along at home.
Oh, some really good stuff to get through this week, starting with a chat about how financial markets reacted to speculation around the future of Keir Starmer as Prime Minister.
Yep, and we've had lots of big names in the UK market reporting earnings over the past week. So Dan and I will be unpacking the key details from numbers from Shell, BP and Barclays.
I'm going to be chatting about why AI has haunted parts of the stock market once again. This time, we've had some financial comparison websites and insurance brokers being the latest victims as investors fear that AI is going to disrupt their industry.
Yeah, and there was some pretty eye-catching news in the pharmaceutical space as well this week as Hims and Hers, which is a drug platform, went from announcing a cut price weight loss drug to being sued by Novo Nordisk just a day or two later.
Now, we'll be exploring the weight loss drug space in more detail, and we'll hear from a couple of experts on the names that perhaps investors want to sort of watch in this part of the healthcare market. So I talked to Trevor Polishchuk from the Worldwide Healthcare about how Eli Lilly has scored the top slot in the market, and Martin Gamble chats to Oliver Kenyon from RTW about other names to watch in this space.
And Charlene Young is on the show to explain why everyone's talking about student loans and why there is some controversy about these products.
Now, we've got Danni Hewson is also going to be with us. She's going to be talking to Pathos Communications about its experience of listing on the UK stock market and also about AI and its use in the public relations industry. But first, let's kick things off with a little bit of chat about politics and how it's influenced financial markets over the past few weeks. So, Tom, now, clearly, we are not here to talk politics. This is an investing money show. But obviously, how did it... what happened and how was it relevant to the type of stuff that people perhaps normally expect to hear on this podcast?
Yeah, exactly. We'd probably try and avoid talking about politics wherever possible. But yeah, the reason we're talking about it this week is because we have seen some movements in gilts, so UK government bonds, which when they get sold, the yields on those gilts go up. So people will talk about gilt yields going up, but that means that the gilts are being sold by investors. And the pound as well. We've seen some volatility in the pound. And as you sort of pointed out in your intro, that's all down to uncertainty over the position of the Prime Minister, Keir Starmer. That really, I mean, it's been bubbling away for a little while, but the resignation of a key advisor at the weekend, Morgan McSweeney, has sort of accelerated that. And this is all kind of the fallout. And we really won't get into this, but about the appointment of Peter Mandelson as US ambassador. So that's kind of the context and what's been happening. Now, we have seen some movements this week. I think it's worth keeping them in context. They're not the kind of moves that we saw after the mini budget back in 2022. And the situation around Liz Truss, but they do portray a little bit of nervousness on the part of the market, and effectively investors are, they're demanding a higher price to compensate them for what is perceived to be a little bit more risk around the UK, potentially around public spending and about the UK's public finances. Because the main fear is that if Starmer were to leave, and as we speak, that's not happened. And I have to assume, or we'll assume that it hasn't happened sort of since we've recorded and since the podcast coming out. But the concern is that whoever comes in to replace him might be less committed to the quote unquote fiscal rules that have been outlined by Starmer and by his Chancellor Rachel Reeves. Now, since the sort of beginning of the week, Starmer's had kind of in football, you'd say the dreaded vote of confidence from his cabinet. But we have seen other figures like the Scottish Labour leader call for him to resign. So I would say overall things have stabilised a bit, but it is one to keep watching. And if people want to see how the market is feeling about that whole situation, then a good place to start is probably the 10-year gilt yield, because that is quite often where you will see evidence of people getting a bit concerned about instability in the UK.
Yes, obviously, yeah. If you see that gilt yield go up, that's the indication of, like, you can say, a little bit of nervousness. Higher yield means that's investors saying, we need this extra reward for the risks that we're taking. So thanks, Tom. Yeah. So I want to talk, on the subject, sort of finance and stuff. So let's kick things off with Barclays, because they've just reported their latest quarterly figures. So I think this is quite interesting, this one. Announced pre-tax profits 1.9 billion pounds. That was better than expected. But I think this is where Barclays really sort of comes into its own, is it's got so many different moving parts. So every time it reports quarterly figures, we kind of getting used to seeing one part of the business is doing okay, but also something's doing quite well. So this time round, it's talking about the investment banking operations have been doing pretty good. But that's quite interesting, because it's currently got 2 years into a 3-year strategy to try to improve the bank's profitability, but also to reduce its reliance on the investment bank. So basically, it's coming out saying the bit that we're trying to be less reliant on is doing really well. So, okay, the investors are going, all right, okay, well, what about the rest? Because clearly the rest really matters. So you've got revenues in the sort of the equity capital markets division fell. I mean, they sort of blamed that a bit on the US government shutdown, which had a knock-on effect on sort of new stock market listings. The UK business, which includes sort of the high street banking operations, that didn't do as well as expected either. So overall, a slightly mixed picture, and that might explain why the share price didn't really do too much on the news. It wasn't all bad news for shareholders. Barclays said it's going to return at least £15 billion to shareholders between 2026 and 2028. Also announced another £1 billion share buyback. So obviously that's on top of 55% share price gain last 12 months, 226% gain over the last 5 years. So I think if you've been an investor in Barclays, you've got. I can't really see a reason for you to be too grumpy about the situation at the moment.
Absolutely. I mean, we always talk about banks being boring, but I guess, in recent times, at least, the kind of returns from the banks have been anything but, really, haven't they? So
yeah, exactly. Yeah. So obviously we had a couple of oil companies. So BP is the most recent one, but Shell was last week. But I think it's probably worth sort of packaging them up together, because they're giving sort of slightly different messages. So Tom, what actually happened there?
Yeah. So I mean, when it came to the results themselves, both these companies now put out a kind of a teaser of their quarterly results a few weeks beforehand. So people were quite prepared for the fact that the results weren't going to be great on either company's part, really. And that's partly down to what's been happening with commodity prices, particularly in the latter part of last year, because obviously they're reporting for the last 3 months of 2025. And we saw a fall in oil prices in that period. So the results weren't great. But I think what's probably worth spending a bit more time on is something that you mentioned with Barclays, which is buybacks. So Shell last week, as you say, came out, and it's interesting because there's been a bit of a trend, not just with BP and Shell, but more broadly with global energy companies, that partly because of the commodity price situation and the need for them to sort of not to overextend themselves in terms of their balance sheets. Quite a lot of companies have been dialing back buybacks and deciding they're not going to be quite as generous with shareholders. But Shell went the other way, so it's continuing to buy back shares at a pretty astonishing rate. So it's going to do another £3.5 billion buyback, and I saw figures quoted that over the last 4 years they bought back something like a quarter of their own shares. So Shell has been quite aggressive with buybacks, and it's going to continue to be, despite kind of what, potentially a little bit of a wobble in terms of performance. Now, BP has kind of done what a lot of the other energy companies have done. And it's actually, I mean, where it's gone a little bit further potentially is rather than just sort of scaling back its buyback, it's getting rid of the buyback completely for now. And that didn't go down particularly well with shareholders. It takes what could have been quite a tough decision out of the hands of Meg O'Neill, who's the incoming chief executive at BP. She's joining in April. And, you can see the logic of it, because BP probably it does have a sort of slightly worse balance sheet than quite a lot of its counterparts. But if you're a shareholder and you're thinking, right, I might need to be a bit patient with BP. They're working on sort of turning around the business. They've obviously been through quite a difficult period that's been quite well publicized. But actually, I'm not being kind of rewarded for that patience to quite the same extent. Then I guess you can see why the shares might have come under pressure when they announced they weren't going to be doing the buyback anymore.
Yeah, I mean, it's interesting, isn't it? Like, you think that these stocks simply just track whatever the oil price is doing, but there's so many more other sort of dynamics going on.
Yeah, there's lots of moving parts with the companies. Somebody like Shell, for example, is a real leader in areas like liquefied natural gas, and so there are a lot of moving parts to keep track of. They obviously have refining businesses. So yeah, it is more complicated than just saying it's to do with commodity prices, but commodity prices are very important, obviously, for these companies, and it's also something over which they have very limited control. So yeah, so it's interesting to see that sort of divergence. And BP certainly felt a bit kind of singled out, or probably could have felt a bit kind of hard done by, in the sense that most other companies managed to sort of deliver some negative news in terms of buybacks, dividends, without getting the kind of punishment that they did. But that probably reflects the fact that BP has just had a really tough time. So people aren't really willing to give it any credit.
Cool. So let's shift the conversation on to AI. I mean, this year, for I know we're only into what is it, like 6 weeks, 7 weeks into the year, but I feel like there's one common theme, and it's like AI. Oh my God, it's going to disrupt this business and this business and this one, and it's like this list every day of something else. So we've obviously had the legal industry, we've had the advertising industry, sort of data providers. So you've got big names like Relx, London Stock Exchange Group. All these have sort of had big share price wobbles. So now we've just had, it's the turn of the insurance sector. So we had in America, they had this company called Insurify has come out and says it's got a way to give insurance quotes whilst you're using Chat GPT. So I think anyone who, if you've not used Chat GPT, it's like it's a bit like using a sort of the Google. You ask them questions, but typically you ask longer questions and then you stay, and they'll give you sort of more advanced answers. It's all using AI here. So the sort of the direction of travel is that you could use these sort of AI tools to try and anything from just getting some information about a topic, or perhaps you want to plan a holiday, or and so what they want to see is for you to be able to go and buy products and services. So Insurify said, yeah, actually you can get all these insurance quotes inside Chat GPT now, and then once you've sort of chosen the one you want to buy, you get directed to its website to finish the transaction. Now the market has basically gone, oh my God, what does this mean for like comparison portals? So you and I might go onto something like Go Compare or Money Supermarket, quite happily sort of browse and get some quotes. But really, if you're now sort of saying that you can just go onto Chat GPT and do it, it's no wonder the share prices in companies that own the sort of comparison portals, Money and Future, being two of them, they really wobbled. And I think this is, it's a typical reaction where investors are going, oh my God, first, and then give it a couple of days or weeks, and people are going, well, is it as bad as we think? We're not sure. So this is what we're seeing in some of these other sectors that have sort of seemingly been disrupted by AI this year. I looked at the insurance sector is actually not, this is not the first time we've seen a bit of wobble. Go back to January. Shares in Admiral fell quite a lot over the space of a week, where in America we had a company called Lemonade said it was going to launch a policy for self-driving vehicles. And what this does, Lemonade is linked to AI because AI is really a part of the business trying to keep costs low and how it uses it in its processes. But the idea of the broadest thing of technology disrupting stuff, Lemonade said it's looked at self-driving cars, particularly Tesla, and said, look, we can see the data. They're involved in fewer accidents. Therefore, these policies should be much cheaper to insure. And then that sort of triggered the debate around, well, actually, if a human is not actually driving the car, should the sort of liability lie with the car manufacturer or the software provider? Therefore, that's directing business to commercial insurers. So a stock like Admiral, which is pretty much gets most of its bread and butter from insuring the general public, then of course is that people saying, does that hurting its business model? So it's really fascinating, and I think that we will be talking about this on the podcast for weeks to come, because it seems to be there's a sense of discovery by investors at the moment saying, okay, right, I can see this sector. Who's going to be next? Who's going to be next? And we'll definitely, when we get more sort of meat on the bone in terms of the impact of those sectors I've just discussed, or who could be next, we'll certainly talk about it. But on the subject of disruption, let's move on to weight loss drugs, because that has been in the news for good and bad reasons. So, Tom, you mentioned at the start about a company called Him and Hers, and Novo Nordisk sort of stepping in and suing the company. Take a step back. Why was people getting excited, first of all, about Him and Hers, and then how did that good news seemingly turn to bad news?
Just to sort of summarize in a bit more detail on Him and Hers, it's a kind of, you call it a telehealth company. So it's a way that people can buy medicines in the US, and we've kind of moved into a new phase with weight loss treatments. So the big development for 2026 is this move into offering a kind of pill-based drug version of the kind of existing weight loss drugs, which you can see why that might have broader appeal than the kind of current injectable form. And what Him and Hers did is they launched their own, what is known as kind of a compounded weight loss pill, and is seeking to basically take advantage of this development in the market and the fact that there's likely to be lots of demand for it. But Novo Nordisk reacted. They're the first company to actually sort of officially bring a pill to market, to put it through the regulator and launch it. And so they said, right, this isn't right what Hims and Hers are doing. They're going to sue Hims and Hers because they've not been approved by the US authorities, and they impinge on, these big pharmaceutical companies obviously have patents on their treatments, and they're saying this infringes on our patent. So Hims and Hers said, we're going to stop selling the pill, but despite that, Novo has said it's going to kind of press ahead with this lawsuit, and Him and Hers saw its shares collapse on Monday this week. Obviously, we're recording on Wednesday, and described the decision by Novo to press ahead with the lawsuit a blatant attack. So, it's kind of, there's this scramble at the moment to try and kind of take a piece of this this market for weight loss pills, and interestingly, in I think the next few months, Eli Lilly is due to launch its own version of the oral drug. So I think there's going to be quite a lot to watch in this area, similar to what you were talking about with the AI disruption over the next kind of few weeks and months.
Yeah, I mean, we certainly we've seen a market that's had just two companies really leading it. So Novo Nordisk being one and Eli Lilly being the other one. What we've seen in the last year is a real divergence here. So Eli Lilly is doing incredibly well. Novo Nordisk is struggling. So what we had about go back a week or 2 weeks, we had Novo Nordisk come out and said it's warning of a double-digit sales decline. The shares fell 17% in a day. It's talking about being hit by having to lower prices, and that's partly to do with initiatives in the US to let consumers be able to sort of use a new portal to connect to drug manufacturers to buy things at a much cheaper price than they were paying before. So, at that point, everyone's going, "Oh my God!" Novo Nordisk has already come out with lots of disappointing news on drug trials for trying to make its products more effective and have fewer side effects. So it's already bad news, and you got more bad news. But then Eli Lilly came out a day later and sort of said, things are going really well for us, continuing to grow. So I think you're definitely seeing this sort of split here, and I think I think people listening might start to be familiar with the product name. So Novo Nordisk sells Wegovy and Ozempic. Some of the brands are interchangeable depending on the territories where they operate. Eli Lilly sells Zepbound and Mounjaro. So I was pronouncing those things. It's hard on the things. So I think studies have sort of implied that that Lilly's Zepbound is a little bit more effective, more superior to what Novo's Wegovy product is. And so you've seen, here you've got two companies, more people using it. theoretically, there should be an opportunity here for lots of companies to be able to participate. And we're going to talk about that in a second, about who else to look at. But I mean, I think just in general, Tom, I don't know what you're seeing, but I'm hearing from lots of people that I know now that they're trying these weight loss drugs. And you can see that there's already various industries that are sort of winners and losers as a direct impact. I mean, what's your sort of take on this phrase?
Yeah, I think you're 100% right. I think it's becoming much more common, isn't it? I think it was something that was kind of talked about, but perhaps you wouldn't necessarily know people who were using it, or perhaps it was a bit more common in the US than the UK. But I think it's starting to spread across the world and increasingly be adopted, and inevitably, the lifestyle impacts of that are having knock-on effect on other sectors. So one area which is quite interesting, and it's something we've looked at, I think we looked at the back end of last year, is that we've seen people splashing out on new wardrobes. So there's evidence that as kind of the benefits, I guess, of taking these weight loss drugs come through, people are kind of, feeling more confident, happier, like want to refresh their wardrobes, and they're going out and spending money. So, that's obviously potentially a benefit for clothing retailers, for clothing brands. So there was a study by a consultancy company called Morning Consult, and it revealed, I think it came out at the back end of last year, as I said, and it revealed that 40% of GLP-1 users feel much more confident, and around a quarter of them reported feeling a little more confident. And both groups reported higher rates of impulse shopping, and clothing was the number one category where people were spending more money while taking these drugs. And with just over a third of them spending more. So that's evidence on, the positive side of the impact potentially that weight loss drugs are having. On the flip side, it's not potentially such good news for fast food companies. And you've seen some evidence more recently that those companies are trying to react to that. So they're trying to offer, at least slightly healthier options in smaller portions to entice, I think it's something like 1 in 8 Americans now who are on weight loss drugs. So certainly menus in the States are starting to be adapted a little bit as they look to respond to this sort of potential threat, I guess, posed by weight loss drugs and the impact that might have on people's literal appetite for fast food.
Yeah, I mean, we saw a very interesting research note from the investment bank, Jefferies, a couple of days ago. They were talking about, how weight loss drugs, like I say, naturally changing food habits. The areas that are really sort of affected are sort of savory, salty, fatty, high calorie foods. And of course, you have to think, well, okay, which companies are sort of selling these sort of products? And they're singling out Greggs, basically saying that people using weight loss drugs are likely to be higher BMI, higher frequency consumers, precisely sort of the people who are really valuable to Greggs. But actually, if a big chunk of its customer base are now using weight loss drugs, what does that mean for its sales? Now, I think we've talked about Greggs loads on the podcast about how the business has been losing momentum. It's been really sort of opening lots of new stores, and there's a suggestion some of those are sort of cannibalizing existing stores. It's raised prices by more than its competitors, and I think there's sort of a slightly sort of bit of a Greggs fatigue we're seeing in sort of amongst the population at the moment. So you got that extra pressure now of weight loss drugs. So what does that mean for demand? It's definitely something we'll keep an eye on. But I want to sort of now bring in a couple of experts to talk about specific parts of this weight loss drug market. Now, a couple of them were on the podcast a couple of weeks ago talking about the healthcare space more generally. But as part of those interviews, I did ask them to talk specifically about weight loss drugs. I kept those sections of those interviews for this episode. So first up, let's hear from fund manager Trevor Polishchuk from Worldwide Healthcare. So he's talking about some of the big names in the space. I think, we talked about, Eli Lilly at the top. So we'll hear a little bit more about that. So this is what he had to say on the topic. I want to talk to you about Eli Lilly. Obviously, it's from an investment perspective, the shares have been very, very rewarding for those who've held them, say, in the last 2-3 years, all obviously driven by the success in weight loss drugs. I mean, obviously, Eli Lilly is a bigger beast than just weight loss drugs. How long have you been invested in that company, and kind of what's your thoughts on it at the moment?
Oh yeah, we've had a multi-year holding in Eli Lilly in the Worldwide Healthcare Trust. It's been a very important investment for us. It also remains our largest single security investment in the trust as well. And it's really multifactorial, Dan, and I think you hit the nail on the head. It's more than just about weight loss. Certainly, GLP-1s and those weight loss targets are a critical factor, but what's really become amazing in this particular space is all the benefits that these drugs are doing outside of just weight loss. Of course, diabetes is very well known, but there are positive impacts on cardiovascular disease, inflammation, immunological disorders. Um, uh, we had a little bit of disappointing news on Alzheimer's disease, but I think there's still some potential there. And the list goes on in terms of not only treating other diseases along the cardiometabolic pathway, but also preventing certain adverse events in certain diseases is really amazing. And we're still in the early innings of this. So I think this is a very sustainable, and it's also the biggest commercial opportunity I've ever seen in my career. And like I said, we're in the early innings of that opportunity.
Because I know that Novo Nordisk obviously is its direct rival for weight loss drugs. Their sort of their recent drug trials haven't been great in trying to sort of make their products more effective. How's Eli Lilly been getting on with obviously the trials it's been doing recently? Because obviously it's made its mark on the weight loss drug world, but there's like you say, there's always ways to try and where else can we use it? How can we make it more effective? Is it having much greater success than rivals?
Yeah, it's a good question. Nobody's flawless in drug development, in drug discovery. Failure or disappointing expectations for idiosyncratic reasons is a common difficulty in investing in healthcare, especially therapeutics. But Lilly has been close to flawless, as we've seen over the past, I would say, 5 years. Again, hasn't been perfect, but Lilly has such a massive lead. They have the best product currently in the market from an injectable point of view. Their next generation product in development, in which we'll have phase 3 data later this year, looks also best in class. Lilly also has an oral product that should get approval in April of this year. That also looks best in class from a variety of metrics. Um, and the list goes on, and we start to layer on top some of those other outcome trials across other indications, not just about weight loss. Lilly looks to probably maintain their lead for another decade. That being said, like I mentioned, this is a huge market opportunity. There is room for others. In fact, we hope there's others that join the fray. It builds more awareness. It builds more secure commercial execution across the industry, better for patients. And that just means more utilization.
Well, yeah, I'm gonna say who are the sort of the names to watch then? Obviously, I know there's quite a lot of companies who would love to be successful in this area, and certainly lots that have been investing, doing stuff. But who's perhaps sort of the second tier that we could see products sooner rather than later?
Right. Well, people still have their eyes on Novo Nordisk to see if they can bounce back. They have new management there. We'll see how they can execute. Pfizer has made some very important deals in the obesity space. We think they could have a best-in-class product from an injectable point of view. We'll have to see. We'll have data coming this year. Roche has important obesity assets. And one company that doesn't get talked enough about is AstraZeneca. They've done some important business development as well as internal development into the obesity space. I think they're focused on the long game. We should have some data this year, but there's a handful of companies that are coming around the corner that could have important product offerings before the end of the decade. One other company I'd mention, Dan, is a smaller company. It's a biotech company called Structured Therapeutics. We recently saw some phase 2 data from them in December that looked best in class from an oral offering as well. So there's a lot of competition, a lot of excitement, and we spend every day scrutinizing each piece of data set we can get our hands on.
Yeah. Well, Trevor, thank you ever so much for talking to us. It's been absolutely fascinating. So brilliant to talk to you.
Great. Thank you, Dan.
Right, that was Trevor Polishchuk from Worldwide Healthcare, and he gave us a flavour of the big names to watch in the weight loss drug space. But what about some of the names that are slipping under the radar? Well, that's the domain of Oliver Kenyon from the RTW Biotech Trust, and he recently spoke to our very own Martin Gamble about one name he believes has big potential. He talks about the next generation of the obesity drug space, side effects, and aspirations to bring a certain company to the stock market later this year. So let's hear what Oliver had to say.
Indeed, one of our most interesting assets in that company creation bucket is a company called Corcell. It's one we've talked about a lot previously. That's in the next generation obesity space. So your listeners, your watchers will be familiar with Wegovy, Mounjaro, the current crop of weight loss injections. We're looking at what comes after those. So how can we improve them? And this company called Corcell has what we think will be one of the first oral pill formulations of obesity treatment. So right now, the only options available are injections. Lots of people don't like injections. They're quite expensive to produce. The current treatment has some gastrointestinal side effects, and often the profile of weight loss is skewed. Although there is fat loss, there is some lean muscle mass loss as well. So we're looking at what comes next. Corcell has what we think will be one of the first pills. And Corcell really touches on a number of things. It's company creation. It's actually a Chinese molecule that we licensed. So we acquired the ex-China rights to this molecule called CX-11. We acquired it on the basis of the Chinese phase 2 data and built Corcell, the company, around that. Since then, we funded it through clinical trials, and the US phase 2 trials will actually read out this year. The next question is probably, where do your new company creations go? How do you exit them? How do you realize value? Well, we would love to IPO Corcell this year to realize full value. That doesn't mean we necessarily exit the investment. We can hold it in the public market because we are full life cycle. But we think we realize full value by IPOing these things. If that happens, or even if it doesn't happen, this will remain a clear M&A target for Big Pharma. There was a clear comp called Metsera that IPO'd in January last year. That was taken out after quite a fierce bidding war by Pfizer at a $10 billion valuation. Yes, exactly. $10 billion valuation last year. Obesity is a very, very hot space, and we think Corcell ticks a lot of boxes in terms of themes. It's our secret sauce at company creation. It's licensed a Chinese asset, and also it's obesity is the largest opportunity in pharmaceutical history.
So, Charlene, thank you ever so much for coming on the pod. As always, good to see you. Everyone's talking about student loans. I wondered if we can talk about this topic. Is something changed, or I was just wondering what's the crux behind why it's suddenly in the news again?
Yeah, it does feel like student loans are everywhere now. No, two things did sneakily change in the budget back in November. So in the budget documents were announcements that the repayment threshold, so the income level above which graduates start to repay some of their student loans, would be frozen for people on the Plan 2 scheme. So that accounts for the biggest bulk, if you like, of the current borrowing for people who started university between the years 2012 and 2022. Some of them in longer degrees will still be at university. So what was snuck in was a freeze of the repayment threshold, so the income level above which you start to repay these student loans at a rate of 9%, income above the threshold. That will rise in April to £29,385, but then be frozen for at least 3 years. So another kind of layer of fiscal drag, if you like, for graduates. More and more people will be dragged into starting to repay their student loan, and there'll be a bigger band of income on which those repayments will be based. That affects people who are starting out on kind of lower incomes, but something that affects people who start their working life on a higher income or have higher earnings potential will also be impacted by a freeze in the different interest bands. So for all student loans, you start to accrue interest on what you've borrowed from the day that you receive your first payment. So that first day of term, if you like. And that starts at an RPI interest rate plus a certain percentage. When you start to move into earning and you're starting to repay potentially some of this student loan, you're still accruing interest, but at different rates. So people earning just around about or just below the repayment threshold, they won't pay anything back, but they'll start accruing interest, or they'll continue to accrue interest at RPI inflation. But if you earn over the higher threshold, it starts to kind of step up. It's just above £50,000. Your interest rate will be RPI inflation plus 3%. So at the moment, that's 6.2%. And I think, these two sneaky things were snuck into the budget. But what's happening now is people are checking their statements. They're repaying their student loans, this graduate tax level of 9% above the income threshold. And it's not even touching the sides when it comes to paying off the interest. Some people might be paying off their interest, but a tiny bit of the balance. But a lot of people at the moment are not even covering that interest. And they're just seeing this borrowing balance, this debt balance balloon, and not liking the sign, of having this burden just as they're kind of embarking on their working lives.
So what? And obviously, after a certain time, they get wiped off. So what's the argument that there's no point in trying to pay off as much as possible? You should just let it. You pay the minimum, and then hopefully, down the line, whatever's left, it will just get wiped off. Or actually, is it? When we look at sort of personal finance more broadly, kind of people sort of say when you've got a debt, you try and pay it off as quickly as possible. What is this different then?
Yeah, so I mean, the government refers to students and graduates as borrowers. So, and it is student loan, student finance, but to day, I think a lot of people on these schemes will refer to it as a graduate tax. They're paying 9% extra tax on income above a certain amount, along with the income taxes that we all pay. So Plan 2, they are written off after 30 years. So, for some people who aren't ever going to get near to paying it back because their payments are barely covering the interest, it's 30 years worth of tax and then the balance is written off. And, if you look at it kind of matter of fact, pounds and pence from a maths point of view, for a lot of people, it may not be worth trying to overpay or trying to pay the entire thing back because it will be written off. However, we've seen that the amount or the volume of voluntary repayments by graduates who took out Plan 2 loans has more than trebled since 2017 to now. So clearly there's a lot of either high earning graduates or their families looking at this and saying, no, we don't want our family members starting their working life with this £50,000-60,000 debt against their name and choosing to allocate funds to pay that off. With student loans, they are slightly different to something like a mortgage, for example, because there is that insurance element. So if you lose your job and your income, dips below that repayment threshold, your payments will stop. That doesn't apply to other types of debt. So as you say, in personal finance, yeah, absolutely. Before you consider investing, you need to have a look at kind of repaying any unsecured or particularly high interest debt that you have. But, at the end of the day, it's still these repayments eat into your disposable income. They impact your lifestyle day to day. They impact what you might be able to do with your money. And ultimately, how much you might be able to put towards things like buying a house or things like childcare. And, we've got those tax traps as well. So people who have started a family, not only are they paying this 9% graduate tax, they might get dragged into a child benefit clawback, or for the highest earning graduates, losing their personal allowance and other childcare support. So really, it's a question, I think, of weighing up this potential for a 30-year tax of 9% versus getting rid of it now. And, practically speaking, as I say, pounds and pence, it might not look on the face of it as like the optimal financial planning idea, but there's a lot of emotion tied to a 50, 60, even more for people like medical students, debt around your neck. So, if you or your family are in the position to repay some of this, I can kind of see why people are looking at doing it.
So does the student loan actually work against someone in terms of, like, for example, if they apply for a mortgage, does the lender say, we can see you've got this debt. We're going to take that into account in terms of whether, your ability to borrow money and repay, or is it not actually treated as like in the way that you perhaps have a credit card or a personal loan?
Yes, you're right. So it's not treated in the same way as kind of other debt balances. So if your mortgage lender is looking at kind of your ability to repay, that doesn't count against you, but obviously it still eats into your disposable income. So a lot of people who are keen on getting on the housing ladder are finding that even if kind of financially or from a borrowing point of view, it's not necessarily holding them back. The thought of having to kind of repay this 9%, having this ongoing tax versus their mortgage repayments is just something that they're not comfortable being kind of stuck with.
Yeah, I mean, what and I guess what is the perfect solution here? Do you think that the fact this is all over the news might prompt the government to say we'll charge less, we'll write it off over a shorter period, or is that it's just pure fantasy? It's not. We're not going to see anything happen then. It's just simply this is raising awareness of a debt issue for students, and you have to just lump it.
Well, I mean, the government is in a tricky position here. If they do reform or they do kind of give some kind of holiday or reduction in interest rate, where does that money come from? And that's quite unfair on people who've obviously repaid or their student loan or near doing so. The thing that I do think, the system overall, I think it's quite clear it's kind of broken and it's not working necessarily in the right way for students and universities getting the funding they need to. But there is one thing that I think could be done, and this has been called for by plenty of people in the press, and it's unfreeze this repayment threshold. That does feel particularly punitive and in some cases quite cruel. So if we were thinking about a conventional loan, necessarily you wouldn't see that contract change, and I think that's what some people have are campaigning for, and I agree that the freezing of this repayment threshold for 3 years, the Institute of Fiscal Studies has calculated this will add kind of an average £3,000 in extra repayments that these graduates will have to pay over the course of the loan. So we're all stuck, we're all feeling the effects of fiscal drag and frozen allowances. Doing this as well just felt particularly punishing. So if I were the government looking to get kind of students and graduates back on my side, there's probably plenty of work they need to do in other areas, but this feels like an obvious one to kind of take another look at.
Yeah, well, Charlene, thank you ever so much for coming on the pod. It's been brilliant to talk about student loans.
Pleasure, thank you.
Right, before we bring on our final guest, Tom, I know you've been really busy putting together the latest issue of Shares magazine. It's just come out. Can you give us a quick run through the highlights and tease some people, why people should be going off and reading this publication?
Yeah, I mean, I would say this, wouldn't I? But there's lots to choose from, I would say, in terms of the highlights, but I will try and kind of keep it brief and just focus on a few. So we've had some kind of pretty significant M&A news, although in the end, the deal that had been floated between Rio Tinto and Glencore didn't happen. And we've seen some very big moves in commodity prices in the early part of 2026. And we've got an article talking all about the mining sector, what the different sensitivities are of that sector, what might happen with it next. So I think that's a really interesting one and a really timely one, given what's been going on in the market. We've got an article on Google owner Alphabet and the strides it's been making with AI. Inevitably, we can't avoid that topic, and nor do we want to. And we've also got an article looking at how to get income from property through the stock market. But there's loads more content in there. And, I think we like to think that this publication gives a little bit of something for everybody, regardless of your experience as an investor and, where your interests lie. So if people want to find out when the next monthly issue is out, then you can go to your communication preferences if you're an AJ Bell customer and click on the receivable messages button in the investing news and analysis section.
So it's always worth pointing out that, you don't have to be an AJ Bell customer to read that. This magazine is a digital one. It's completely free. Absolutely anyone can go and look at it and read it for free online. It's on the AJ Bell website. So please, we do encourage you to do it. You go enjoy. Tom works very hard to put it together. So I'm sure he'd appreciate all the clicks.
Yeah, no, absolutely. And yes, thanks, Dan, for giving it that push. But yeah, no, we're proud of what we produce. And yeah, the more people that can read it, the better.
Okay, well, we've got time for one more segment, and it's a fascinating chat with a relatively new name to the stock market in the UK. Now, it's fair to say it's been a bit of a tough start for many software services businesses this year. Investors are perhaps, we discussed earlier that they're sort of wondering what's going on with AI. There's sort of concerns that perhaps big tech companies are spending too much money and stuff. So, it's quite interesting that we've managed to, we get a new name. It's sort of new listed Pathos Communication. Unfortunately, it's already been caught up in the sell-off, but its chief executive Omar Hamdi is pretty upbeat about the challenges his company faces. So Danni Hewson met up with Omar to have a good chat about what's going on. Pathos is betting AI is actually going to help disrupt the world of PR. Recently announced that full-year revenue is going to be significantly ahead of forecast. So Danni talked to him about all the sort of challenges for the company, why he chose London for the company's recent IPO, and actually how he would go about persuading other companies to come and join the UK stock market. So let's hear from Omar and Danni now.
Okay, Omar, thanks so much for joining us on the AJ Bell Money and Markets podcast. Just explain for people who don't know, what is Pathos Communications?
Well, Pathos Communications is if the technology world looked at the PR world, and the PR world's an old world, and looked at the PR world and said, let's drag this kicking and screaming, not just into the 21st century, but into the year 2026, and then realized that because of this wonderful thing called technology and this wonderful thing called AI, suddenly PR can be viable and it can work, not just for more mature companies that can afford to hire a traditional PR firm, but PR can now work for the 400 million SMEs in the world. So it's as if someone in Silicon Valley woke up and said, I want to run a PR firm. And then the love child of that would be Pathos.
Okay, love child sounds interesting, but boil it down. How does it work differently then from other PR firms? Because there's been a lot of talk about PR changing, marketing and advertising changing. How is it different?
Yeah, absolutely. And I think that whole space and sort of the agency space, I think it's quite an old industry, and it hasn't necessarily changed as much as it could have or perhaps should have in recent years. And naturally, people look at that space and say it's not the most exciting industry for us to invest in and to get behind. So how it works is we have two AI tools that we've built from the ground up, proprietary AI tools that we've built ourselves that we use internally every hour of every day. Pathos Mind, which is our AI agent stack. Think of that almost like the mind of a PR firm. And Prosella, the virtual publicist. So if you think about all the things that a PR firm would do for a customer, monitoring the news, finding news hooks, generating story ideas, actually crafting content, that is all done in an automated way at Pathos, which means that we really work very differently. Now, I've got to say, humans are really important too, and it's important for everyone to understand that, is that we are absolutely of the view that when technology and humans work together, that's when the best results happen. So our customers can get ideas faster and more efficiently from us than they would if everything was done by a human. But it's still a human making sure that it's good. It's still a human putting that final touch to it. And it's still a human ultimately managing the relationship and the customer service level. And it's what we're seeing across all professional services. I think the law firms, I never thought I'd say these words, I think the law firms led the way with this. So you see law firms getting very excited about using AI. I think the accountancy firms are now, reluctantly dipping their collective toe in the water. PR, as far as I can see, is really just still in the 20th century. So we're very excited about just the size of the opportunity. As soon as you have technology supporting you, so you don't have to tell customers, you have to pay us a monthly retainer of £10,000 a month before we lift a finger. As soon as you take that away, suddenly there's so many opportunities.
Now, AI really has been like fairy dust for a lot of companies. But I think what we've seen in recent days, recent weeks, certainly this week, as we're recording this on Friday, some of the air really has been squeezed out of some sectors. You were talking there about legal firms using AI. Some software operators have really seen share prices fall because of those changes announced by Anthropic's Claude, some of the AI tools there. Your share price has also fallen. Do you think investors are putting you in that same basket?
You'd have to ask investors what they think. I would love to be put in the same basket if someone says, Palantir, for example, Nasdaq listed. I think its current PE ratio is 205. So they are valued at 205 times earnings. I'd love to be in that basket. Do you know what? Let's cut the price in half. 100's enough. So I would love to be in that basket. I think naturally when you're a growth company, share prices go up and down, and we're not here, watching the share price hour to hour or day to day, and I don't think the majority of our investors are either. If someone needs to sell £1,000 worth of shares because they want to go on holiday and they'll take whatever price is offered, that doesn't say anything about our business. And, we're very much worried about, the 6, 12, 24, 36 month vision and just continually under promising and over delivering, which we've already done just a few weeks after our IPO.
I mean, you're just talking about your IPO, under promising, over delivering, being a growth company. For a while, UK investors, they weren't so good with growth companies. They liked the jam today. They weren't so much into the jam tomorrow. That is changing. As you say, you have just debuted on AIM. How did that go?
It went great. And I think one of the many things I love about Pathos Communications is you get jam today and tomorrow and hopefully the day after. We've got a good track record of being profitable and cash generative. This isn't the case of, a nice business plan has IPO'd on AIM. This is a business that has grown up completely organically over 6 to 7 years. It's got to some scale being completely bootstrapped, completely self-funded, i.e. funded by its own cash generation. So this is not one of those AIM floats where it's all, jam tomorrow or maybe even jam next year. To answer your question, the IPO went very well. I think it's a great ecosystem that we have in the UK, and you can see that some really, really high quality, very, very shrewd, very smart institutional investors backed our IPO in a very, very significant way, which is obviously that means a lot to us, and every one of our stakeholders is really energized by our newly listed status. The team now know exactly what they're a part of and exactly what we need to deliver this year. Our customers love it, prospective as well as ongoing customers, and of course our partners and our suppliers in the media, news publishers. It's very, very valuable for them to have a partner in us who is now a listed company with that governance, with that quality management at the very, very top of the company. So it's been a great couple of months so far.
So that's the good. Is there any bad? Because certainly when you choose to list, there is more governance involved. And a lot of companies have also chosen to list outside of London. So why list? What have been the bad bits, the things that made you pause? And also, why choose London?
Mm-hmm. Yeah, it's interesting. People say, "Oh, Omar, are you ready for governance?" And well, if you really believe, like I do, that my life's work is this company, and that my life's work is taking this company from the teens of revenue to the hundreds of millions of dollars in revenue, then you're probably going to need some governance at some point. So you might as well get it in now. You might as well get it in now. It's like, I'll start exercising next month. Well, maybe go to the gym tonight. Why not? So that's really how I view governance, and at every level of the company, from our team leads up to the key management team, up to the board. It's very important to me that we have the highest quality of management, and we absolutely do. Some of the CVs of our board members, but also some of the CVs of our key management team. A lot of them are serial entrepreneurs who've had successful exits in the past and joined Pathos a few years ago and see that as their next project. So it's a really, really strong team at every level. The second question, why choose London? First of all, why not? I think it's important to start with that. We're a British company founded by a British entrepreneur, so why not London? At the same time, it wasn't sort of blind patriotism that drove us to list in London. We spent about 2 years looking at really every market around the world, from Canada across to Hong Kong, from Stockholm down to Australia. It was a pretty rigorous process. And I think the USP of London is you've got a top tier established stock exchange, one of the greatest and biggest stock exchanges in the world, that gets as excited about Pathos raising 5-6 million quid as they do about, a multi-billion pound company floating. And that's really quite special. And I think I don't think we maybe celebrate it as much as we could or should in the UK, that especially with some of these AIM IPOs like Pathos, where we're backed by really high quality institutional venture capital trusts. We are democratizing VC. We're democratizing venture capital. In Silicon Valley, unless you're a multimillionaire, you cannot invest in venture-backed companies. It is a closed shop. If you want to back the next OpenAI or the next Anthropic, you got to make probably tens of millions of dollars first before anyone will even return your call. And even then, you're entering a very opaque system where people get allocations and you don't really know what you're investing in. I think what we've got in London is great, where someone can. I think one of the funds that backed us, I think their minimum is £2,000. Someone can have a spare £2,000, and their financial advisor can put them into a VCT, and they can be invested in potentially a high growth tech enabled business. And I think it's a wonderful thing to do that with the transparency, with the governance of being listed. And I think it's a great thing. And I think that's why so many companies from all over the world come to London. It's not because they love the weather.
Certainly not today. What about retail investors in particular, those that don't have maybe a financial advisor, people who are just DIY investors? There's been a huge amount of talk in the past couple of years about getting more people investing, particularly in UK companies. We've seen a great start to the year for AIM. Do you see that progressing?
Yeah, I think absolutely. And retail investors exist and they are enthusiastic. It's just they're enthusiastic about the shiniest asset classes. I mean, the number of friends I've got who almost as a hobby will bet, and frankly, it is betting. They will bet on some crypto coin that they've never heard of. And I'm not talking about, say, Bitcoin or Ethereum that are probably in a different bracket. Whatever your view is, they are in a different bracket. I'm talking about people, really, frankly, gambling on, some random crypto coin that they've just discovered at 3 a.m., the night before. The appetite is there. I just think maybe we need to tell a better story about how exciting some of these businesses are. It's quite interesting to me that there are so many massive success stories, too many for me to mention in this interview, but there are so many stories of businesses doing an IPO on AIM at the same kind of size as Pathos, and then within a decade they're a FTSE 250 company and they're one of the biggest listed companies in the country. But for some reason, what's more exciting is some 18-year-old in a t-shirt just raised a $10 million seed round. And, I don't get it myself. So I just think we've got to be a little bit more celebratory about some of the quality of companies that we have. And perhaps also being a little bit honest that, maybe in the past, not all of the companies in the market were of the highest quality. And I think one of the benefits of a tougher market, a more selective market like the one we're in now, is generally it's the higher quality companies that can make these deals happen. There isn't a huge amount of money just being thrown at people. And that's great if you're a retail investor.
You're in communications, so how do you tell that story? How do you strike that chord with people? Because that's certainly something that the government's looking to do.
I think it's very simple. The rest of the world is getting richer because they back high growth companies. Investors in the US, in Australia, where it's a very, very sort of retail oriented stock exchange, all over the world, investors in the Middle East, they are getting richer every year because they back companies that grow. Too many British investors are either just about maintaining their wealth or in real terms getting poorer because the interest rates that, high street banks give are sometimes, below inflation. So it's very simple, Danny. Do you want to get richer or do you want to get poorer? Decide what you want and make your choice.
Omar, it's been lovely to talk to you. Thank you so much for your time.
Thank you.
That's everything from us this week. Don't miss next week's podcast, where we'll be talking to a fund manager about tentative signs of a much overdue improvement in market sentiment towards smaller companies. And we're hoping to have an expert on to explain why big tech firms are turning to the bond market to fund their AI growth plans. Until then, thanks again for tuning in.
This podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell. The podcast isn't telling you if a certain investment is suitable or not. The value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.